Hi everyone, I'm Kanika and welcome to my channel Value Investing with Kanika. Today I'm going to cover up 8 basic finance terms that will help you analyze a company's financial health. So let's start. First of all, what is financial analysis? It's about checking the financial health of a company, how well the company is doing. Is it making money? Is it having debt? Is it growing? So start with the basics before diving into the financial analysis of a company. So the first one is the profit and loss statement, which is also known as the income statement. So the P&L statement tells about the financial performance of a company for a given time period. It provides information about the income, expenses and profits. Next is the revenue, money earned by a company by selling of goods and services. Like selling 500 pair of shoes at 1000 rupees each, so the revenue earned is 5 lakh rupees. Net profit. So net profit is the amount left after the company pays all its expenses like rent, employee salary, production cost, raw material cost, income expenses and taxes. So the formula for net profit is revenue minus expenses. Balance sheet. Balance sheet tells the financial position of a company at a particular moment in time. It provides information about the assets, liabilities and equity at the end of financial reporting period. Assets. Asset is a resource owned by an individual or a company that is expected to provide future monetary benefits. It includes cash and cash equivalents. For an individual, it could be home, savings, investments, and for a company, anything that generates cash flow. So asset could be a tangible asset, which is a real physical asset like real estate, machinery, vehicles, or an intangible asset, which is a non-physical asset like brand names, patents, copyrights, goodwill. Liabilities. Liabilities are the obligations what the company owes, like the loans, the unpaid bills, payables to the supplier for the goods and services purchased, other debts. Equity. Equity represents ownership in a company. So the amount left for the shareholders of the company after the company pays all its debts. So the formula for equity is assets minus liabilities. Cash flow. Cash flow is the inflow and outflow of money. So if a company's cash inflow exceeds its outflow, it's a positive cash flow. Otherwise, it's a negative cash flow. So why is cash flow important? In P&L statement and balance sheet, accounting is done on accrual basis, which means the income is recognized when it is earned and not when it's received. Similarly, the expense is recognized when it is incurred and not when it is paid. Suppose a business does a cash purchase of 1 lakh rupees and a sales of 1.5 lakh rupees. So the profit earned is 50,000 rupees. What if the purchase is done on cash and the sales is done on credit? The P&L statement would show 50,000 profit on papers, but the money is not yet received. Even the capital is lost, therefore the cash flow needs to be assessed. So there are 3 types of cash flow. Operating cash flow, the cash flow generated through the core business operations. Investing cash flow, which is done on account of assets like buying and selling of assets, buying a new factory, loans, giving loans. And financing cash flow, which is done on account of liabilities like borrowing funds, raising equity, dividend payments. So now you have the basic tools to start reading company financials. If you found this video helpful, do like, share and subscribe. Thank you. See you in next video.